So over the last 1 year, as the market has made new highs, Alibaba stock is down over 50%. And comparing this to its peers JD and Pinduoduo, we can see that it is clearly the worst of the bunch. Pinduoduo surprisingly isn't too far behind, but JD is actually in the green here. So that's a very interesting observation, and we're going to dig a lot deeper into that in this video. But first, let's talk here a bit about Alibaba. This is an infamous stock, especially here on YouTube. A lot of people either love the company for its fundamentals, its valuation, and just kind of its future prospects. And a lot of people, probably more people than love it, hate it and think that it's a terrible investment. There's a lot of Chinese issues and fears and regulation concerns around the company, and it just doesn't make sense to put your money there when there's equivalent, better American stocks you can invest in instead. And I see both sides of these arguments. To be honest, right now, the side that's like stay away from Alibaba has clearly been correct. But the question is, over the long term, when investors will come back to the fundamentals of these companies, will Alibaba still underperform the market? Will it still be down 50% plus from its highs? Now, personally, I am in the camp that I'm still a believer in Alibaba. I still think they're executing well. And I'm going to show you the numbers here today that kind of support my thesis as to why this company is still a great investment, especially when you compare it to its peers. Now, as of today, I'm down quite a bit on my Alibaba position. A lot of you watching are probably down as well because the stock is hitting new 52-week lows almost on a regular basis here. So what I thought we'd do in this video, instead of just talking about Alibaba by itself, let's bring in its competitors, let's bring in JD and Pinduoduo and do a comparison video. Now, the reason I want to do this video, guys, is because in its last earnings report, Alibaba actually cited concerns from its competitors. You can see here, quote, they said that intensifying market competition also affected their core commerce business in China. So right there, with the CEO of Alibaba acknowledging that competition is starting to eat their lunch and take market share away, I think it makes sense at this point to reevaluate and look at Alibaba, compare it again to its biggest rivals and see, is our money better kept in Alibaba, or should we consider moving it to JD or Pinduoduo? Now, the way we're going to break down this video is very similar to what I did yesterday on my fintech stocks video, and I know a lot of you guys enjoyed that. If you haven't watched it, check it out. And guys, if you want to see more videos like this in this sort of detail, smash the like button, subscribe, and let me know in the comments down below. Okay, so the best place to start off with these kind of videos is, I think, the three most important metrics that investors look at from a very high level. It's market cap, the revenue that the company's pulling in, and the revenue growth. These three factors give us a general idea of the health of the business. Now, here we can see that we have varying sizes for these companies. Alibaba is by far the largest at over $377 billion in market cap value. JD is second on this list at $142 billion, and Pinduoduo is the smallest of the bunch at just over $100 billion. Revenue estimates, though, are another story. JD is actually the largest one here, expecting to pull in over $182 billion in revenue in the next year. And this is followed by Alibaba at $136 billion in revenue. And finally, Pinduoduo, the smallest again, at $24 billion. Growth year over year changes things up once again. Pinduoduo leads the pack this time with double the growth of the other two. Over 40% year over year is expected. And JD and Baba are expected to see very similar growth in kind of the low 20% range. So this was very interesting right off the bat. And I bet a lot of us did not know that JD was actually pulling in more revenue, or is expected to, than Alibaba. That is quite an achievement here. This is why I enjoy doing these comparison videos, because there's a lot of little insights that you don't really pay too much attention to until you actually put these companies side by side. And this is kind of the value in these sort of videos. So I think you take a second, let's understand what we just read, okay? JD has the most amount of revenue coming in, and I think that's because they sell, higher ticket price items, more quality items, and that results in more revenue. Pinduoduo, the smallest company of the bunch, is still in growth mode. It's seeing 40% plus growth expected, and it should continue that sort of growth for the foreseeable future as it tries to catch up to its two big brothers here. That being said, because it's such a small company and the revenue is still in the $20 billion range versus the $100 billion plus for the other two, that 40% growth isn't that crazy. It should technically be a lot higher than that, but 40% is 40%. It's still pretty good. And then finally, we have Alibaba with the largest market cap. And you may be wondering, why is Alibaba's market cap so much more than JD and Pinduoduo? And the answer is because Alibaba is a much larger, more diversified business. Although the core Chinese e-commerce makes up around 43% of the company from things like Taobao and Tmall, Alibaba also has other parts that they're investing in heavily, including cloud, digital media, and other side bets. Alibaba is a massive company, and that's why the market cap is significantly higher than JD and Pinduoduo. As of their last report, cloud, digital media, and logistics make up around 20% of their revenue, and I believe over time this will grow much larger, possibly making up 30 to 40% plus of the overall revenue for the business. So the key takeaways so far is that Alibaba is the most diversified company with other segments that you're getting investment exposure to. JD is the largest revenue driver here, and Pinduoduo is the fastest growing business. Okay, so that was just step one. Let's dive a little bit deeper now into some more numbers to see some more differentiating facts between these three competitors. So I thought we'd look next at the traditional price to sales metrics and compare that to its historical values. Here we can see in terms of EPS, Alibaba is leaps and bounds ahead of the other two. Price to sales though for these three companies currently tells us that all three appear to be significantly undervalued compared to their historical numbers, but Baba, guys, comparatively is by far the cheapest here. But here's the thing. I don't think price to sales makes a lot of sense for this. I wanted to throw it in here because a lot of you guys look at price to sales, but I want to explain why I don't think it's the best metric for these kind of businesses. E-commerce companies sell products, and because of that, they generate a ton of revenue, but the actual realized profits from that is a lot less. So other metrics like price to earnings makes a lot more sense for these type of businesses, in my opinion. A lot of revenue doesn't necessarily mean a lot of profit. At the end of the day, you're investing in a company so it can generate a ton of profit. Now, objectively, price sales is a great metric. It's good for like high growth companies, SaaS type companies. I like using price sales there because those companies typically aren't too profitable yet, but they will be in the future. But in e-commerce, not the best metric. So now here's where things get interesting. Although JD has the most revenue, it also has the worst gross margins, meaning that they don't make nearly as much money from every sale versus the other two. Pinduoduo has the best gross margins, but when we look at the operating and net margins, they're both negative for this company currently, and to me, that's not something that I'm personally interested in when the other two competitors are positive. That being said, JD is kind of barely positive here. It isn't too much better, but Alibaba is in a league of its own with high gross margins, high net margins, and high operating margins. And this is because, like I mentioned before, Alibaba is the most diversified business, the most mature business. They have a lot of history behind them, and they've kind of ironed things out over the years, and that's clearly showing in their margins. This efficiency has helped Baba become a monster free cash flow company, guys, expected to generate over $21 billion next year. Surprisingly, Pinduoduo is the next highest with over $5.5 billion next year, and JD is the lowest with $3.7 billion in free cash flow next year. All three of these names have strong free cash flow expected, which I love to see, but Alibaba is once again in a league of its own with over $20 billion that they can use for things like reinvestments or, well, buybacks. With buybacks here, guys, both JD and Baba have programs running. Alibaba has $5.66 billion remaining on their buyback program, and it's according to my calculation, and JD has around $1.2 billion remaining. Pinduoduo still smaller and still growing, so no buybacks announced here as far as I could tell. So this is another huge factor to consider. We've looked at things like their revenue growth, their profitability, their margins, which are important, but free cash flow and share buybacks drive a ton of value, especially in the market conditions today. Two metrics to really measure the quality of a company and the stability of a company would typically be high free cash flow and high share buybacks. You can look at the massive American giants, Microsoft, Apple, Facebook, Google. These companies all generate a ton of free cash flow and also do a ton of share buybacks, and Alibaba is literally part of that league. Only difference, of course, is that it's a Chinese company, not a US company. Now, Alibaba, guys, is actually running a $15 billion buyback program here, and they raised this from the initial $6 billion they announced back in 2019. And I had to go through a bunch of their recent reports to gather this data because they don't really make it quite clear on how much money they have remaining to be spent on buybacks. But as per my calculation, they've spent so far $9.3 billion in the last couple of years. Now, buybacks can be good and bad, right? Buybacks are good when a company is really good at deploying their capital and they're still reinvesting, but they have excess capital and they want to reward shareholders. So in those situations, buyback makes sense. But then there's times where you have companies that just don't innovate, don't do anything, but they buy back shares. In those cases, I'm not a huge fan of buybacks. But here with Alibaba, they're clearly still investing. They're clearly still doing things right. They're clearly still growing as well. So share buybacks on top of that is a nice bonus. In the last quarter, they bought back over $5 billion worth of their shares. And that tells us that they believe their shares are cheap right now. So now, based on the metrics we've looked at, guys, I think it's kind of clear to me that Alibaba is the strongest business here. You could make a case for Pinduoduo if you want to look for growth, but JD kind of falls in the middle. It's not a company that really screams great value, great growth, or anything like that to me. It's kind of in between. But interestingly enough, it's also the only company that's green on the year versus the other two. So maybe there's something that the market sees in JD. Maybe they're misunderstanding Baba and Pinduoduo, but only time will tell which one of those cases is correct. But regardless, let's look at our final metric here, which I believe is an extremely important metric for these companies. That is price to earnings ratio. And I think this applies more to Baba and JD. Pinduoduo, not so much because right now they're not profitable, but they expect to be profitable. So price to sales makes a little more sense there. But anyways, let's jump over here and we can see that based on historical data that I could gather, JD does look quite expensive, and Pinduoduo, like I said, just turning profitable also looks expensive. But again, if we go back to the big dog, Alibaba, we can see that this one's at a 16 forward PE, which is much, much lower than its historical average and much lower than most companies out there with similar metrics. Alibaba, the company, is growing at over 20% year over year, is generating over $20 billion in free cash flow, is buying back their shares aggressively, and has extremely strong margins compared to its peers with a much more diversified and stable business. So to me, with my investment style and me kind of focusing on the top quality companies, Alibaba fits right in there, and the current prices that we're seeing are just a bargain for this stock. Now, I know, we've been saying that for months on end here with Alibaba when it was at 180, 160, 150. But the point still remains, it does look cheap and it is still undervalued in my opinion. Now, like I said, an argument could be made for Pinduoduo because that 40% plus growth is quite attractive for some investors. However, with the added risk and the lower margins and the lack of profitability right now, not the best place for my capital. Maybe it makes sense for you, but to me, I think Baba still stands out number one here on this list. So while Alibaba addressed competition, while investors are concerned about competition, I still think the clear winner here in terms of business, in terms of fundamentals, in terms of execution, cash flow, most metrics we looked at, Alibaba stands number one. Now, if these numbers deteriorate over time, maybe that's cause for concern. However, if they see slowdown in growth, something like the high teens, something like, I'm still okay with that. As long as we don't see negative growth year over year, that's when things may start getting much worse for this company. But as of right now, investors seem to be pretty pessimistic on this stock. I seem to be pretty optimistic. I'm still buying into Alibaba. And I think over time, once the US markets cool down and maybe Chinese markets pick up again, that's when the investors that have held throughout all of this pain may see some reward in Alibaba. Anyways, guys, I'll have to wait and see if that plays out. But let me know, did you enjoy this video? I want to make these videos for a couple of other sectors as well for stocks that I'm looking at. So let me know if you have suggestions in the comments down below. But either way, I appreciate you watching this. Thank you so much for your support. Don't forget to invest positively, and I'll see you in the next one.